Today I'm going to share 7 metrics I use to help find winning stocks. Whether it's buying Broadcom in 2023 for a 51% gain, Tesla for a 98% gain, Microsoft in 2022 for a 33% gain, ExxonMobil in 2020 for a 206% gain, or even Tesla in 2016 for over a 1300% gain. However, not every investment is a success. In my years of investing, I've made many mistakes, whether it was AT&T, Disney, Intel, Walgreens, etc. Every failure is a lesson, but it'd be preferable to avoid them outright. As Charlie Munger says, it's better to learn from other people's mistakes.
Learn a lot from other people's mistakes. That is really a much more pleasant way to learn hard lessons. And I think this constant study of other people's disasters and other people's errors has helped us enormously.
In this video, I will create a list of key metrics to look at when researching a stock based on my personal investing experience. That will include the lesson and a direct example to help drive home the point. The goal is to find better investments and avoid money-losing stocks. All of this is built upon a fundamental understanding I learned from studying Warren Buffett. Stocks are just an ownership stake in a business. It may seem simple, but this fact impacts everything about investing. That is a lesson Buffett learned from his mentor Ben Graham, who is known as the father of value investing.
Got me thinking not as a stock as something with a ticker symbol that wiggles around and that you look at charts on or anything. He taught me to think about it as part of a business, and that was vital. And he taught me not to really pay any attention to stock market fluctuations except when they were working in my favor, so that not to get elated because something had gone up or depressed because it went down. So if I knew the facts on something and it went down, I bought more of it, because I looked at it as a business.
A stock is just a piece of a business. Therefore, when you value a stock, you should look at what the business produces. With this understanding, Warren Buffett explains the basics of stock valuation in the following clip.
The only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. The question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question of how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground. You're laying out cash now to get more cash back later on. And the question is how much are you going to get? When are you going to get it? And how sure are you?
The only logical reason to invest in a financial asset is to get more cash back in the future. That's the basics. The 3 main questions to ask are how much cash are you going to get, when are you going to get it, and how sure are you? This way of thinking is all part of my investing framework on how to pick winning stocks. It's about finding the optimization point between those questions. A big part of that process is learning how to research a stock. You need to know what financial metrics are important and how to think about them in context to our goal. In today's video, I'm going to explain 7 different financial metrics I look at when researching stocks. On top of this, I'm going to provide an update on my long-term dividend growth stock portfolio. This is all part of a monthly series where I share the progress of my investments. The goal is getting a great total return while building a compounding source of dividend income. Let's roll the intro.
How do I make money?
It's not what a businessman thinks about in buying businesses. So why think about it when buying stocks? Because stocks are just pieces of businesses.
But guess who's still on the air?
My name is Zach, this is Dividend Data, and you should leave a like and subscribe if you enjoyed the video. Throughout, I'll be using my stock research tool, which is available at dividenddata.com. This aims to provide all the necessary data to make better investments and avoid money-losing stocks. If the software helps you identify just one slightly better stock, then it pays for itself. On top of this, you can track your investment portfolio on dividenddata.com and get related dividend income analytics. The consistent measurement of this data is vital if you actually plan on reaching financial freedom and living off dividends. If you want to try out dividenddata.com, there is now a 14-day free trial. Sign up, become a member, use our tools, and follow along with the video. Link in the description and pinned comment. Now let's dive into my portfolio. The current value of my dividend portfolio is $128,043. With $100,348 invested to fund the portfolio, my total return now sits at 27.6%. This has seen a decline since my last update. The S&P 500 is down nearly 4% over the past month. Most notably, the big tech stocks, which led market gains in the first half of 2023, have seen weakness. Both Microsoft and Apple are down by nearly 11% from their recent highs. Microsoft is my top holding by a wide margin, and Apple is one of my top stocks. I view them both as core long-term holdings. With these stocks, I am excited by declines in price as it gives me the opportunity to buy into the business at a lower valuation. However, I'm still waiting for more of a price decline before buying again. With Microsoft, I'd likely start buying more in the low 300s and below. With Apple, I'd start buying in the low 150s and below. My top 3 stocks include Microsoft, ExxonMobil, and the Altria Group. Collectively, these stocks make up slightly over half the value of my dividend stock portfolio. Some may say this is highly concentrated and not diversified enough, but that is a topic for another video. My worst performing investment is Disney, which is down 40%. There are a lot of lessons to learn from that mistake. Ironically, part of my new buys was Disney stock, which I'll discuss later. This portfolio is projected to generate $3,676 in annual dividend income. That is $919 quarterly, $306 monthly, $10.07 daily, or 42 cents hourly. My projected income has increased by over $130 since the last portfolio update. That income will continue to grow from reinvesting earned dividends, new stock purchases, and dividend growth. That is the dividend snowball effect at work. All of my stocks pay quarterly dividends. That gives me a 3-month payment schedule. Here you can see August is my lowest month at $109, September is my highest at $457, and October is $351. Here you can see all the individual payments that make up the selected month. Additionally, I track my actual history of earned dividends. Since starting my portfolio, I've generated $9,650 in dividends. Last year, this was $3,297, and year to date, it's $2,137. After making major portfolio changes in 2022, I'm back on course for future dividend growth. Since my last update, I bought 3 different stocks for a total of $1,837. This is led by 25 shares of the Altria Group at a cost per share of $43.54. Altria is a high-yield, reliable dividend growth company. My dividend yield on cost is 8.63% for this purchase, generating $94 in annual dividends. Additionally, I bought 6 shares of Disney at a cost per share of $86.68. Disney still has its dividend suspended, but is on its way to bring back a modest dividend. Free cash flows are starting to improve, and their streaming services are marching towards profitability. I could go into much greater detail, but this is not a Disney video. However, it is a topic we discuss frequently in our community Discord server. You can join the Discord by being a member of dividenddata.com. Finally, I bought 1 share of Visa at a cost of $228.48. This is a dividend yield of 0.79%. Visa is one of my favorite dividend growth stocks, and I'm looking to buy more in the low $230 and below. So how did I come to the conclusion to buy these stocks and the many others already in my portfolio? Well, it's from my investing framework that helps me find winning stocks. Let's recap what we already learned from Warren Buffett at the start of the video. 1. Stocks are a part of a business. 2. The only reason to put out cash now is to get more cash back in the future. Before I get to the key financial metrics, let's add a few more Buffett lessons to that list. First, you should only invest in something you understand. This is what Warren Buffett calls staying in your circle of competence.
Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, and stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should.
If you don't understand something, the odds of you making a mistake go up massively. You don't have to make money in every game. You should stay in the areas you understand. That's where the odds are in your favor. The probability of success is higher. Of course, you can still work to expand your circle of competence over time. Finally, you should look to invest in a wonderful business. There are plenty of stocks who are financially very cheap, but low quality. You should always prefer the wonderful business. This is something it took Warren Buffett many years to learn.
You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money. Time is the enemy of the lousy business. I could have sold Berkshire, perhaps liquidated it, and made a quick little profit, one puff. But staying with those kind of businesses is a big mistake.
Time is the friend of the wonderful business. It will continue to grow and compound on itself. Over the long term, the ability to compound is vital in order to be a winning stock. So how do we find these wonderful businesses? A big part of it is understanding how to analyze the financials of a company. Today, I'm going to share 7 financial metrics that will help you find winning stocks. All of this data is available on my stock research tool, dividenddata.com. The software shows every key financial metric displayed with detailed charts and tables as well as calculated growth rates. Currently, there's a 14-day free trial, so there is no risk in signing up. I'd recommend creating an account and following along. First, I'll explain one of the core concepts, which is the market cap. It's calculated by taking the current share price multiplied by the total number of shares outstanding. A simple way to think about this is the theoretical cost of buying 100% of the business. That is the total value of a company's stock according to its market value. As Warren Buffett says, you should think about buying a stock with the same logic you would if you were buying 100% of that business. So with the example of Microsoft stock, it has a market cap of $2.4 trillion. That is the shares outstanding times the current share price. So why is this important? Remember, the value of a business is all based on the cash it will generate in the future. So are all the future Microsoft cash flows worth $2.4 trillion to you today? That is the core question to ask when investing. As an investor, it's important to look at things on a per share basis. For example, we have the price per share and the earnings per share. Not only is this easier to wrap your head around compared to billions and trillions, but it accounts for changes in the total shares outstanding. That number is not constant. A company may issue more shares, diluting your ownership, or buy back shares, increasing your ownership stake. That is something very important to understand, which I will explain more later. Many of the financial metrics I share today will be on a per share basis. So now we need to answer the question of how much cash is a business generating. To start, let's look at revenue. This is the top line money generated from business operations, typically the sale of products and services. That's the money before all the operating expenses, taxes, debt repayment, capital investment, etc. In my research tool, I show the compound annual growth rate over 1, 3, 5, and 10 years. On top of this, you get decades of quarterly and annual data displayed graphically and in tables. The most important thing here is positive revenue growth. In general, the higher the better. With positive growth, the business is expanding year after year. Over the long term, the business will begin to dwarf its former self. Let's look at Tesla stock for an example here. Over the past 10 years, the compound annual growth rate of Tesla's revenue is a massive 58%. This level of growth is absurd. The 5-year CAGR is over 40%. In an expanding business, time is your friend. Not every company will grow like Tesla, and that's fine. There are plenty of companies with reliable high growth year after year at a slower rate. However, a lack of revenue growth is hard to combat. It's difficult to cut your way to prosperity. There is only so much juice you can squeeze out of the same revenue. For example, Verizon's revenue has been flat for a decade. In a competitive and capital-intensive industry like telecom, there is only so much you can do to squeeze out more profits without growth. A decade from now, Verizon's revenue won't look all that different from its current level. Without growth, it's hard to generate strong long-term returns even if you buy it for cheap. That said, revenue growth is a very crude metric. You need to make sure that growth is economical and profitable. There are countless companies who follow a growth at all cost mindset. One example of this is the software company Twilio. The business is growing revenue at a 36% 5-year CAGR. That seems great, but if you look under the hood, the company's losses were expanding. They are burning money quarter after quarter. In 2022, the market sentiment shifted and the stock price got crushed. This is true of nearly every unprofitable growth stock. People lost tolerance for money-losing businesses. Remember the fundamentals. You are laying out cash now to get more cash back later on. This means that the business needs to generate cash that actually could be returned to shareholders. So what financial metric measures that? Free cash flow is the most important metric to measure. This is the cash that remains after a company pays all the expenses to support its operations and make any capital expenditures. It's operating cash flow minus capital expenditures. Free cash flow is the true cash that is available to be returned to shareholders. Once again, the ideal situation is reliable growth year after year. Visa stock is a great example of this. The 10-year CAGR of Visa's free cash flow per share is 19.6%. That is fantastic. With this, we should focus on the long-term trend. There will often be quarters or years where free cash flow takes a dip. You need to build your intuition about where you think free cash flow is going over the long term. Consistently declining or negative free cash flow will absolutely crush a stock. I've seen this time and time again. For example, Intel had declining operating cash flow and at the same time was spending massive amounts investing into new factories. This flipped their cash flow upside down and they are now burning money. There is no doubt that's a major factor in the stock's large decline. In fact, it caused them to cut their dividend payment. Sometimes this large capital investment is good and could help the company long term. However, the one certainty is that you're taking money out of the shareholders' hands right now. Declining or negative free cash flow is rarely a good sign for investors. It's not always a death sentence though. There are plenty of companies who turn it around. For example, Tesla flipped to positive free cash flow in 2020 and it's poised for long-term growth. Tesla reinvested massively for decades to build a foundation for future success. It's a capital-intensive manufacturing business. What do you expect? They make cars. That behavior creates risk for investors though, as you are speculating those cash flows will eventually come. Some businesses like Amazon make a consistent practice of reinvesting nearly all their operating cash flow. As an investor, this is a risk you need to be aware of. You are solely relying on the execution of the business and will rarely, if ever, see capital return to shareholders. Like Charlie Munger, I prefer the business that drowns in cash. He explains why perfectly in the following clip.
We tend to prefer the business which drowns in cash. It just makes so much money that one of the main principles of owning it is you have all this cash coming in. There are other businesses like the construction equipment business of my old friend John Anderson. And he used to say about his business, you work hard all year, and at the end of the year, there's your profit sitting in the yard. There was never any cash, just more used construction equipment. We tend to hate businesses like that.
Yeah, it's a lot easier to understand a business that's mailing you a check every month.
So if you prefer that kind of business, then you should prioritize free cash flow when researching stocks. The next question to explore is, what does the business do with all that cash? Well, they can return it to shareholders via various methods. First, there are share repurchases, which have grown in popularity. This is where a company buys back its own shares from the market. This reduces the shares outstanding and increases the relative ownership stake of all the shareholders. This means you own more of the company. Apple stock is famous for its massive share buyback program. Since 2012, they've decreased their total shares outstanding by over 40%. That is massive. A 3 to 7% reduction every single year. For context, Apple spent $89.4 billion on buybacks in fiscal 2022. This is their primary way of returning capital to shareholders. The inverse of buybacks is dilution. This is where companies issue more shares to raise funds for the business. This is fine in many cases and is a core function of the stock market. Typically, companies earlier in their growth cycle will use this. However, you want to make sure you are not being taken advantage of as a shareholder and being massively diluted. Most of the time, you'd prefer to have shares outstanding declining, not increasing. Second, there is the dividend. This is the distribution of a company's earnings to its shareholders. Judging by my channel name and investing strategy, you can tell I love a good dividend-paying company. It's part of that drowning in cash philosophy. These businesses regularly pay cash to shareholders. You can use that money however you please, like paying bills, saving, investing in companies, or reinvesting to buy more shares of the company. Most stocks pay out on a quarterly frequency, but there are also monthly, semi-annual, annual, and special dividends. Consistency is one of the most important factors I look for. I like to know that my dividend is secure, with commitment from management, and only poised to grow. I look for companies who have a history of increasing their dividend payment year after year. Similar to other metrics, the dividend growth rate is very important to focus on. Over the long term, a consistent dividend grower will pay more and more cash to you. Future payments will begin to dwarf prior payments. You want to look for a business and dividend that compounds. In addition to this, you need to determine the financial security of that dividend payment. The primary metric for this is called the payout ratio. Typically, this is based on net income, but I think that version is flawed. Net income uses GAAP accounting, which includes non-cash expenses like investment write-downs. In my opinion, you want to look at the payout ratio based on free cash flow. This is an issue I discuss frequently when we talk about Altria stock. Luckily, I built out that exact custom metric on dividenddata.com. That payout ratio is the percentage of free cash flow being paid out as dividends. This aims to show how sustainable the payment is. Now, every company is in a unique situation, but in general, lower is more sustainable. A lower payout ratio also gives them room to reinvest in growing their business. Typically, you want to avoid stocks whose payout ratio is consistently over 100% or negative. If you study the free cash flow trends, then you can typically predict when a dividend cut may be incoming. For example, that risk was very present for Intel. Aside from paying attention to a business's cash flow, you should also look at its balance sheet. For example, cash on hand is a very important metric to look at. This lets you know how cash rich the company is. This isn't just for the security of the business, but it's also part of growth. Cash allows a business to invest in itself and make acquisitions. I like a hefty cash cushion. For instance, Microsoft stock has $111 billion in cash as of 2023 Q4. This allowed them to acquire Activision Blizzard in a massive all-cash deal. A strong cash position puts you in a position of strength. On the flip side of that, you should stay away from companies loaded with massive amounts of debt relative to their earning power. This takes away from your future cash flows. You have to pay off that debt eventually. When debt is used excessively, it can put pressure on a business. It means shareholders will be rewarded less and it will be harder to invest in growth. The final financial metric I want to share today is yield, specifically dividend yield and free cash flow yield. These are financial ratios which show the return an investor will earn annually based on the current share price. A dividend yield is the current annual dividend divided by the share price. Microsoft has a 0.84% dividend yield, which is quite low. Likewise, free cash flow yield is the annual free cash flow per share divided by share price. This is higher at 2.35% for Microsoft. These metrics show the current cash produced and distributed relative to the market value of a stock. It's an important part of the valuation equation. If a stock has a low yield, then you must expect high future growth for it to be rational. If a stock has a high yield, then you may expect or be more willing to accept lower growth. In my dividend growth stock portfolio, I own many high yield and low yield stocks. They each have their place. The topic of how to properly value stocks is so big it deserves an entire separate video, so I'll likely make one soon. If you've enjoyed the video, leave a like and subscribe on YouTube and review on Spotify. You can sign up for dividenddata.com to track your portfolio and research stocks just like me. There you will gain access to the exact tool I used throughout the video. If the software helps you identify just one slightly better stock, then it pays for itself. Thanks for watching.